Good evening. Thank you for joining us. My name is Sheena Pasco. I am the Director of Marketing for the Startup Path. Welcome to the Startup Path webinar. Tonight we'll be discussing the fundamentals of venture valuation. We are pleased to offer these free webinars because we believe in entrepreneurship. Before I introduce our guest speaker, I would like to tell you about the resources we've created for you at the Startup Path. Step 1 features our free webinars where you will learn the basics of starting your own business. Step 2 provides you with assessment tools to help you find the right fit between who you are and the wide variety of business opportunities that exist. Step 3 enables you to learn a business from a mentor. We currently have 26 mentors online who reveal their tips, techniques, and secrets to success in a wide range of industries. We've packaged each mentor's journey and advice into a talk show format that we call the Startup Experience. Look for our newest lesson on international exporting. It should be live in the next few days. Steps 4 through 6 contain 21 online lessons that cover everything you need to know about starting, growing, and running your own business. The featured speaker in today's webinar is the Startup Path's resident expert in entrepreneurship, Dr. Tom Duening. Dr. Duening is the Director for the Center for Entrepreneurship at the University of Colorado in Colorado Springs. He has been an entrepreneur since 1984 and has started and ran several businesses in his career. Dr. Duening has also written 12 books on business and entrepreneurship and has consulted with startups in a wide range of industries. Please be aware you may see the waiting room screen come up again as we transition into Dr. Duening's presentation. Today he will be giving insight on venture valuation, and it is my pleasure to introduce to you Dr. Tom Duening.
Thanks, Sheena. Well, tonight we're going to be talking about venture valuation. And everybody's interested in this topic that has their own business for lots of reasons. Number one, if you want to raise some capital, you have to have some idea of what your venture is worth, because it's the value of your venture that will determine the degree of your dilution when you take equity capital from investors. The other reason is that you want to build the value of your company over time so that if you ever have an exit event at some future date, the focus on enterprise value over time will lead you to have the most lucrative exit that you can attain by virtue of the strategies that you've deployed and used over the life of your venture. Venture valuation is a really interesting topic to talk about in entrepreneurship because there are so many facets to it. And yet at the same time, even though it is a technical process, there's quite a bit of art and persuasion and negotiation and other things that are involved with establishing a valuation for a venture. The longer your venture is in business, the more likely that technical factors will have an overriding weight in the ultimate valuation that your company establishes. But in the early days, before you've actually begun to function, and maybe even as you're assuming that your business is going to grow very rapidly in the coming years, a lot of the things that you use to establish a valuation are sort of speculative. So most entrepreneurs will go through the exercise of establishing a financial forecast, and some of these financial forecasts can be as far out as 5 years. And of course, nobody has any idea what's going to happen 5 years from now, much less tomorrow. But yet these financial forecasts are used to some extent in establishing a valuation of a startup venture. So if your venture is older, your business has been around for a few years, certainly you can rely upon your historical financials to get a better handle on what your growth looks like, what your trajectory looks like, whether or not you've got steady customers and recurring revenue and things like that help to add to the overall valuation. But in the early days, a lot of it is the art of persuasion. And so we're going to be talking about both sides of this to some extent. I think the art of persuasion, as I mentioned before, is going to be far more valuable to those who are in a startup venture and need to raise some capital and therefore need to argue for the highest possible valuation that the market will accept in the short term, and then they have to grow their venture to reasonable levels in the long term. So there's a lot of different approaches to valuation. So if you've been in ventures for a while, if you've been in entrepreneurship for a while, you've probably heard of the simple multiples technique. And that simply means that you find some kind of relevant metric that applies to your industry, and you apply some multiple to that to determine what your business is going to be worth. And I'm going to give you some examples of what I'm talking about there in more detail in a minute. Discounted cash flow, this is a technical analysis of your actual cash flows or your projected cash flows discounted to a present value. And of course now the argument becomes, what's the discount factor that we need to use to establish a present value? And depending upon the type of investor you're talking to, the discount value could be very aggressive in the case of venture capitalists, or maybe less aggressive in the case of angel investors and others. Multiple of net asset value, this would be basically where you add up all the assets of your company, establish a value for them, and certainly if you've got an accountant on your team, they'll be able to do that. And then whoever wants to acquire your assets would put some multiple on that, maybe 2 times, 3 times net asset value, based upon their assumption that they're going to be able to use your assets to grow your business even more than you can. And then relative valuation is where you use the 2 techniques, really. It's using a multiple technique, but you're also comparing yourself now to others in your industry space to see what kinds of valuations have been placed on their firms. And you can argue reasonably, and a lot of investors will accept this, that if a certain company that's very similar to yours has achieved a certain certain valuation, you can use that as a benchmark to establish the valuation of your company. So just some principles of valuation. So you'll hear a lot of these terms, right? Book value of your company, the liquidation value, the replacement value, and the intrinsic value. These are all sort of accounting terms, if you will, for the value of a company, and they really don't apply very much to the valuation of your venture in the case of raising capital or in the case of executing some type of an exit, maybe an acquisition or an initial public offering. In those cases, valuation can be widely different from the different types of value that an accountant might place on your venture. So an accountant might say, look, I'm going to establish the book value of your company, and that's the depreciated value of the assets minus your outstanding liabilities. And of course, that's a nice accounting number, and it can be fairly technically achieved and can maybe even be deemed to be right or wrong. But the valuations that we're talking about are never right or wrong. In fact, depending upon how persuasive you are or how good of a negotiator you might be able to get values far in excess of the book value of your company. The liquidation value, again, this is something that accountants would know, and that's the amount that would be raised if all the assets were sold off in the current marketplace. The replacement value, that's another way of looking at the value of your company. That means that basically it's the market price of all of the equipment that you use to run your company, not the outstanding stock. This slide is a little bit incorrect. Replacement value is the value of what it would cost you to replace all the equipment in your company. And of course, that would be higher than the liquidation value. Generally, to replace something means you're going to get something either for something new or something in the marketplace that is going to cost you more than it would just to go and have a fire sale of all your stuff. The intrinsic value of your company is the net present value of your future cash flows. And again, this is similar to what we talked about before in terms of the discounted cash flow method of valuing your company. So the multiples technique is a technique that is most often used as a sort of what we call a desktop valuation. And you can get a pretty good handle on what the value of your company is by using this technique. And that means simply that you find a key metric within an industry. So, for example, with Facebook, right? So Facebook has got a $50 billion valuation. It's like, why? How did that happen? They don't even have revenues close to that, nor profits at all. It's not a profitable company. How can it be worth $50 billion? Well, the key metric in the social media space is the number of registered users that have signed up and continuously return to that platform, and that is the key metric. And so, so you look at, let's just say that Facebook has got 50 million registered users. I don't know what the actual number is, and if it's worth $50 billion, right, then you know that the actual valuation is some multiple. What is that? 100 times 50 million? Don't ask me to do the math. Maybe it's 1,000 times 50 million. to get to 50 billion in valuation. So you know that every registered user is worth $1,000 of valuation in your company. So if you're building a social media company that's sort of like a Facebook and allows people the opportunity to connect with friends and so on, that the registered users is a very key metric in your industry. And each one that you are able to get, if, according to this multiples technique and using Facebook as your comparable company, is worth $1,000 to you. And so therefore your business strategy should be aimed at building those registered users. And so the next question that you might ask is, well, why do those, why do people believe that those registered users are worth $1,000 a piece? And the answer is, it really doesn't matter why they think that. I mean, they do. And probably, I'll give you some kind of, high-level explanation of why they think that. And the reason they're thinking that probably is because they think that somehow or other, along the way, Facebook or whoever buys Facebook or whoever's leading Facebook is going to discover how to make money from all those registered users. And they'll be making money at least at $1,000 a user. And it's going to get to that at some future date. So a lot of these valuations that are coming out are not tethered at all to revenue. They're not tethered at all to profits. They're tethered to these key metrics that will lead people to believe that, in fact, if these things begin to come together, that we'll be able to figure out how to make a lot of money with this company. So, you have to think about your own business in that way. And so here's an example, right? So, you got to decide on your basic metrics. What are the important metrics in this industry? So if you're going to open a restaurant, a restaurant, I can tell you right now that the most basic metrics that are used to value a restaurant if you want to sell it to somebody else is generally going to be revenue. And it's going to be, what is the historical revenue that we've been able to generate from this store? And of course, then it's going to be some multiple of that. And in general, restaurants are acquired at 1 times revenue, sometimes maybe 2 times revenue. If somebody sees that it's in a great location and the traffic is exactly what they want because they want to redo the entire store and offer maybe some different cuisine or something or a different atmosphere. In some cases, it's earnings. Companies are more interested in the fact that you've developed an operation that actually creates earnings, and that means that there's profits, and so you've got enough revenue to exceed your costs. And sometimes your business can be very valuable to somebody that hasn't figured that out yet, and they want to bring in your operations, and so they acquire you at some multiple of your earnings. A lot of businesses are interested in what we call the free cash flow. And free cash flow simply refers to the cash that's flowing through the company that isn't otherwise encumbered by some future liability. So it's free cash flow in a sense that no bank has got a claim on it. No employees have claims on the cash. It's the business is actually throwing off all this free cash. And so a lot of companies will look at your free cash flow, and believe me, that can be a very, very valuable thing for companies that are finding it very difficult. They can be profitable, but they're not throwing off that much cash, and they need cash to grow. So buying a company based on free cash flow can be very important. So you have to find out if you're interested in growing your business, if you're interested in building your enterprise value, you've got to figure out what are the key metrics in my industry that are going to be regarded as very valuable over a period of time. And if it's revenue, then you got to focus on getting revenue, and recurring revenue is going to be more valuable than acquiring new customers on a regular basis. If free cash flow is the thing, then you got to figure out how can I maximize my free cash flow so that I can get acquired. And I've got a friend that gave me a lot of good advice over the years on building and selling companies, and he said, look, build your company every day as if you're going to sell it tomorrow, and that means your strategy should be focused on those key metrics from the very beginning. Here's an example of a company I worked with last year, and this is an internet-based company that sells high-speed internet services. And what we're doing is we're trying to put a value on the visitors. So you can see that in Q4 of 2010, this company generated 265,354 visitors, which roughly is about 100,000 a month. So you look at, okay, so a visitor comes to the website, but what is that visitor worth? And it's not only that we did this analysis based upon what the customer is worth to us. We were thinking about what is the value of that visitor to the company that might acquire us. So it was, this is a small company. It's run by a single individual who really doesn't have the resources to scale it. He's making pretty good money with it, but he figures if some big company would buy it, that they'll be able to generate anywhere from $1.50 per visitor up to $2.25 per visitor. And we did this analysis now with each of these different returns per visitor metrics in place, and the same, as you can see, the same number for the quarterly visitors in place above each of these different columns. So in the case of here where we think the average visitor value might be $2.25, the quarterly value to the company with 265,354 visitors is almost $600,000. And of course, if you multiply that by 4, then it's $2.4 million, okay? So now you say, okay, so a company that really knows what it's doing can generate $2.25 per visit from all these visitors that are coming to this website, and they'll be able to do it over a long period of time. So they're not going to pay you just this value right here. They're going to give you some multiple of that value. So we said, look, it might be 3 times that, and that's $7 million, which is 3 times is 2.388186, or maybe 4 times, or maybe 5 times. So that's how companies will value what it is that you're doing, and that's how it is that you can really generate tremendous returns if you are in a hot, high-growth industry where the multiples can be anywhere from 3 to 4 to 5 times revenue. And generally, the internet is a great place for getting these unbelievable multiples. Sometimes I've seen them as high as 10 to 11 on revenue, because obviously, there's a technique to generating the monthly visitors. There are techniques to extracting more value from each of those visitors. And if you can build a little something that is generating pretty steady returns and sell it to somebody else that can take it to the next level by investing in it and making it better, you can get 3 or 4 or 5 times the revenue that you're generating. So, for those of us who are maybe no longer at a point in life where, starting a big car manufacturing plant, or, investing in the next space initiative, private space initiative, doesn't seem like it's going to be in the cards for us. It might be possible to build something on the internet where if you can generate decent types of visitor traffic and you begin to monetize that traffic, you can sell that web environment for 3 or 4 or 5 times the revenue that you're generating on it. So if you generate, say, $250,000 a year, and you can sell it at a multiple of 4x, that means you sell a business for $1 million. And that's something, this business that I'm referring to with this model right here, the individual built this company in less than 2 years. And as you can see, it's got tremendous valuation already. We decided not to sell in the end, and we decided to go ahead and continue to build the company, and we've been doing that for the past year. So again, the discounted cash flow method, I'm not going to go into that in any kind of detail. For those of you who are good at accounting, it simply means that you are going to try to find the present value of some future cash flows. And in general, you're going to look at a discounted cash flow from, let's say, 2 or 3 years out. And that means that you have to figure out some type of a discount rate to discount that future value into the present value, and that's basically, one sort of benchmark for the value of your company. But of course, again, anytime you're doing that, you are working with forecasted cash flows, and depending upon how well anybody that's maybe debating with you or negotiating with you, you're going to look at the assumptions that underlie those projections of cash flows. And of course, again, now your persuasive skills and negotiating skills are going to come into play. So even as technical as this looks, there's an equation there, and gee, it's going to get pretty precise. At the end of the day, it's really not that precise, because your future cash flows are going to be based upon thousands of assumptions that you've made about how it is that your business is going to function 3 years from now, right? And so even though this looks technical, there's still a lot of fuzziness around it. And what matters then is your ability to convince whoever it is that's interested in your technique that in fact you've used a very objective approach. So the intangible value of your company is really what we're talking about. Things like companies are going to be interested in acquiring your company if they can recognize some cost savings as a result of maybe buying your company for a lot of the techniques that you've developed. Maybe you've developed some proprietary software or other types of things. All of that creates tremendous value for your company. It may be that they can buy your supply chain and increase their own production because you've been very good at establishing supply chains in remote parts of the world where labor is very inexpensive and yet you're able to get quality goods. They might buy it because it's going to contribute to their overall what we call organic growth. And that means that they're just going to be able to use your products and services to grow their bottom line without having to take in any outside capital. They might buy it because they think that your technology is superior to theirs and that the life of your technology is going to outlast theirs. They might buy you for brand identity, your intellectual property, and the strategic relevance of your technology. So all of these things you need to keep in mind when you're building enterprise value. So it's not just about, be very careful that it's not just about making money. I mean, that's a key part of it, and certainly a lot of companies are very interested in your ability to generate cash flows. But in the early days before you've begun to do that, your business still has value based upon the things that you're doing on these intangible factors. So if you've developed some intellectual property that has tremendous value, if you're developing some brand recognition in the marketplace, that has got tremendous value because, once that brand is established and I've got some customer loyalty, I can continue to sell new products into that channel. And, and savvy marketers are aware of the power of a brand. So a lot of the things that you're going to be doing to build enterprise value are not going to be directly related to the ability to make money. But again, that's not discounted. It's just that these additional factors will lead to your ability to argue persuasively for much higher value than you would be able to maybe argue for, especially in the early days when you're just not making that much money. So the way to increase your venture valuation is to, have your business show steady revenue increases over time and earnings increases over time. You want to have steady clients. It's nice to have what we call referent clients, and these are big name brands that you're working with. That's great. We had a guy come in the other day. He's got a company. They have seeded paper that they use to make greeting cards and things. And man, he was throwing all these clients that they have, Toyota, Coca-Cola, and others. And, I just got an error message here. Are we okay?
Yeah, we're good, Tom.
I guess so. Okay, got an error message. But good. Okay, good. So you want to have good clients, and you want to brag about that, and there's nothing wrong with that, and especially if they will allow you to go ahead and use their name and maybe even give a testimonial on your behalf. You don't want to rely on a single source for supply that makes your business very vulnerable to any kinds of shocks that might occur to the system. You'd like to have a diversified product or service line. You don't want to be a single product kind of company. And recurring revenue is always the best. People love recurring revenue, and it does increase the value of your company. So let's just talk about the funding process. I'm going to use the term venture capital here, but it's not necessarily venture capital that we're talking to. We might be talking to angel investors or others. But let's just use venture capital as sort of a placeholder here for investor, okay? So you're going to make your pitch to multiple investors. You're going to, bring your business plan, your financial projections, and all that kind of stuff. Nobody's going to invest without being able to see what you are projecting for the future of your business. Typically, a savvy investor is going to engage in what we call due diligence. They're going to take a look at your business from a lot of different angles. Do you have any liens against the business? Are there any lawsuits pending against you? Have you been doing your accounting according to the established rules of accounting and so on? And they'll be looking at some other things just to make sure that everything is as you say it is. If you get a lead investor is somebody that steps up and says, I'm in this thing, and go ahead and tell other people that I'm in because I'm committed to this deal, and I want you to get the money as fast as you can. They might even allow other potential investors to call them to ask, why are you investing? A lead investor can be a critical part of your overall fundraising process. So now, once you get that, then of course you're going to be arguing about the valuation. You're going to be talking about, how much money do you need? What will be the various investors' share, and then what are going to be the terms of the investment. So let's see how that works. So basically, so if you're going to get multiple rounds, then you're going to repeat that process over and over. So let's just take a look at, the terms of investment. So typically, if somebody's interested in your deal, they're going to lay out a term sheet. And here's where it can get kind of interesting for the entrepreneur, because the question is, who puts the terms down first? Do I lay the terms out, or do I wait for the big kahuna to come in here and lay the terms out? And I always say, look, don't wait for them. Lay the terms out. Say, this is my value. This is what I think the value of my company is. This is how much I'm going to raise, and here's how much you're going to get for the amount that you're putting in. You can talk about some other things. You can certainly leave it open to negotiation in terms of board seats, drag along and tag along rights, and those are just rights that refer to future rounds of investing. Just, whether or not the current investors are going to get an opportunity to reinvest to keep their relative position the same. Liquidation and dividend preferences, non-competes, and other kinds of things that you can talk about. Now, these are negotiable, but in general, you want to put a number on the table that says, this is what I think my company is worth right now. And to wait for somebody else to come and do that, means that they're probably going to have to come in and kick the tires and do a bunch of analysis. Nobody knows your industry better than you do. And therefore, I don't think it's a problem to put a number out there as long as you're comfortable with that number. And you might even want to make sure that you're comfortable with a range, because most likely there's going to be some pushback on the number that you select. If there's not pushback, then you probably went too low, right? So that would be a bad thing. So pushback isn't a bad thing. It's just, what can you live with? So there's a certain number that you're just not going to go below. So let's say you're coming on the blocks and you say to the investors, my company's worth $750,000. And they're like, well, where'd you get that number from? And you can talk about the metrics, like we said before. You can talk about the comparables that have occurred in your industry, and you can talk about the multiples that are being used. And, the investor's not going to know better than you. And so they might say something like, well, that sounds reasonable. Okay, $750,000 it is, right? Or they might say, I've done a little bit of research myself, and it looks like, you're a little bit high on your multiples, and I think your company really is probably worth more like $600,000. And, it may be that you can live with that, or, maybe you're going to take a little bit less capital than you thought, so that the dilution factor still does not get to be that, that burdensome for you as an entrepreneur. Certainly you want to maintain a relatively healthy equity position in your own company. That's why you started your company in the first place. Of course, as you move up the food chain, and as you go to more and more sophisticated investors, eventually maybe even talking to venture capitalists, the fundraising process gets a little bit more one-sided. They have all the money. They're going to dictate terms a little bit more aggressively, and most likely they will also dictate valuation and other types of things about control of your company. And if you ever get to that point, it's probably not a bad thing anyway. Given that you're an entrepreneur, you started the company, you may not have the skills really to take a company to the next level. So let's just take a look at valuation. Now here's some very basic terms that you need to know. So the first term is pre-money valuation. And pre-money valuation is a term that is used to refer to the agreed value of the company prior to the round of investment. And that means that at this moment, on this day, right now, at whatever time it is here, 6:30 in Colorado Springs, my company is worth $750,000. Okay? So let's say that I want to raise $250,000, and I find one individual investor that wants to do that. So and the moment of that transaction, right, because my company is worth $750,000 before the transaction, the money goes in the bank, well, that's another $250,000 that has come into my company. So at that moment that transaction has occurred, my company is now worth $1 million, 750 plus 250,000. And therefore, the relative position of the investor is determined by their position in the post-money value of the company. So if they put in $250,000, the post-money value of the company is $1 million. They have now taken 25% of my company, and I've been diluted by 25%. And there's some example here. You can see $5 million invested on a $10 million pre-money gives the investor 1/3 of the shares. So make sure that you are understanding that it is the post-money value that determines your relative ownership position in the company. If you want 100% pre-money, that's fine. But when the money comes in afterwards, it's the post-money value of the company. That means the pre-money value plus the investment. And that's what you use to determine your relative ownership position. So, what are investors looking for? They're looking for committed and experienced management teams. They're looking for a defensible technology. They really want a growth market. They don't like, it says not a consultancy. They want to see that you, in fact, are able to scale. If you are a consultancy, for example, that's exceedingly labor intensive and very, very difficult to scale. That's why these internet business models are so beloved today, because they seem to be infinitely scalable depending upon the number of people connected to the internet. You want to have significant revenues, and of course you want to have a realistic sales and marketing plan. So the number one thing, however, that VCs look for is a committed and experienced management team. And your experience can include success as well as failure. VCs are really not that interested in, certainly they want to see that you've been successful. They don't want to see just a string of failures. But a few failures, that's just, there's a lot of unknowns in the marketplace. And, what they're looking for is, did you learn from that? Are you coming back now with something much better than you did before? So structuring a deal typically begins with founder stock. And the founder stock is issued right away when a company is formed, and I recommend that you get this out of the way immediately. Make sure that everybody's comfortable with their relative position in the company, and you want to do it well in advance of any fundraising, because the founder stock is regarded by the IRS as virtually worthless if it's distributed well in advance of any future fundraising. And the reason is that if you distribute this founder stock, let's say you get 10,000 shares, and you turn around next week and now you're going to go sell shares to investors for $1 a share. Well, the IRS would consider that to be that you were given a gift of $10,000 the week before, and you now have a taxable event. But if the time between the founding stock distribution and the raising of capital in a later round of investment, if there's enough time in there, the IRS will say, well, it's reasonable that they created that much value during that period of time, that in fact the stock that was issued originally was worthless, and only now is it acquiring more value by virtue of the sweat, so therefore it's not a taxable event. You will only have a taxable event when you end up selling your founder stock at whatever future time you can do that. So there's common stock and preferred stock, and we've got some other webinars where we talk about that in more detail, the differences between common and preferred. And let me just quickly say that common stock is the most commonly used distribution of when you're raising some capital. Preferred stock typically comes into play when you're going after some venture funds and so on, where they're going to demand some type of a preferred position in the company. Mezzanine financing and bridge financing, these are companies that will provide financing to a venture only because they're in between rounds, or they're about to experience some major transaction and they're running out of cash and they just need a little bit more money to get to that transaction. And these companies will come in and provide that. Convertible debt is just another instrument that can be used, and we do have an entire webinar that talks in more detail about convertible debt. So the deal making, all right, let's just quickly go back over this again. You negotiate. All right, you might negotiate with multiple parties. You're going to collect different term sheets or issue different term sheets. You're going to select one term sheet will be the one that will be used in any particular round of financing. It's going to be, they're going to negotiate some terms. You're going to come up with a draft or concept contract. A little bit more negotiation, and the lawyers are going to get involved and develop a final contract. It's called closing, deal closing, and there's the signatures, and then the money will hit the bank. A lot of times with major rounds of financing, the money comes and is distributed in tranches rather than all at once. But for smaller rounds like $250,000, $500,000, $750,000, generally the money is collected all at once and then is used to grow the company. This is our last slide, so I just want to talk about some terms. Again, remember the concept of multiples. You want to remember that relative valuation depends upon your ability to find the value of companies in your industry and to look at the important metrics that they've been using to establish those values. Book value is just, again, it's an accounting term that really doesn't have to do with the total value of your company. Your value of your company is going to be based upon a lot more factors than just your tangible assets. And the market value of your company is the value of the stock in the marketplace based on both the tangibles and intangibles. And don't confuse that with market capitalization. Market capitalization is a term that refers to public companies that have a bunch of stock floating around in the marketplace, and there's a price every minute of every day that's placed upon those outstanding shares. And the number of outstanding shares times that minute by minute moving price is the market capitalization of the company. The term sheet, that's usually offered by the first investor, but as I said before, even though it's not necessarily the case that the entrepreneur wants to put a term sheet out there, certainly I think you want to have and be prepared to offer the what you intend to conceive as a fair valuation of your company. So don't go presenting to investors in the early days of your venture unless you have a very, very good idea of what you want to get for a current valuation of your company. They're going to ask you, and if you say, "Look, it's up to you," let's work this out together, then you are forfeiting your power, and you just don't want to do that. Don't forget that funding occurs in multiple rounds. And generally, you do not want to have what's called a down round. That means that the company's value goes down from one round to the next. In general, when you take other people's money, you want to use it to build enterprise value. So remember, the value of your company is based upon lots of factors. These factors have to do not only with sort of the technical numbers that you're generating in your company, but also all these intangibles that have to do with what it is that you're building. So if you're in a really hot industry and you're building something really neat, you can get tremendously high valuations that have absolutely almost nothing to do with the hard numbers of revenue and earnings and cash flow. So you want to build as much of that value into your company as you possibly can. So when you're in a stream, when you're in a flow, you want to make sure that you are also on the crest of the wave. And part of that means that you understand what are the key metrics in the industry, and you are making sure that your business strategy is focused on attacking those key metrics, building the enterprise value around those key metrics, and then finding a way to continue to do that over the period of time. So enterprise value is a new term that we might have thrown out here today that many of you maybe haven't heard of, but the real purpose of business, entrepreneurial ventures, is not about revenue and cash flow and profits. It's to build enterprise value. And that means that you are focused on these intangibles as much as you are. Certainly you got to have cash flow and all that stuff to survive. Don't get me wrong. But your shareholders and everybody else, including you, are going to benefit much more if you keep the entire concept of enterprise value in your mind as you are executing your business plan. So I thank you very much for coming tonight. I hope you enjoyed this webinar. Please come back to the Startup Path for all your entrepreneurial needs. We're always here to help. Thanks very much. I'm going to send you back now to the conference organizer.
Thanks, Tom. That was a lot of information in a short time. So just so all of our attendees know, we do have webinar archives in step 1 of the startup path. So if you visit our website on step 1 where you can sign up for the webinars, there's also an archive listing right below that on step 1. There's a lot of information in this webinar, and we also do have a full lesson on venture valuation available to you. Tom also hosts that lesson. I urge you to register and learn more about venture valuation. In fact, for joining us today, we're going to offer you a 25% discount or anything else at thestartuppath.com that you would like to purchase. There's a coupon code at the very top of your screen. Go ahead and write that down. You can use it to check out. We have a little box down there, discount codes, so just put the coupon code in there and you can get 25% off any item you buy on the Startup Path. We look forward to helping each and every one of you reach your goals and dreams. Please stay in touch. We are definitely here to help. You can also connect with us on Facebook, Twitter, and LinkedIn. Also look for updates to Dr. Duening's blog on our website. Thank you for joining us this evening. I hope you have a great night.